Alright, let's get into it. The currency war is unfolding right in front of us, and most people have no idea what's actually happening. This isn't just about the dollar dropping or some vague concept of de-dollarization. This is systemic. Countries around the world are watching the U.S. dollar, the so-called reserve currency, get hammered, and they're not just watching, they're preparing. Everyone sees what's happening. They know Trump's trade policies had consequences. They know Powell's rate cuts have consequences. And they definitely know Besson's relentless borrowing has consequences. And now those consequences are catching up. As global trade with the U.S. slows, so does demand for dollars. Less trade equals less need for the currency. That's basic. But when you mix in aggressive rate cuts with endless debt expansion, the result is currency debasement. That's what we're seeing. The dollar is no longer the prized asset it once was. Dollar premiums? Collapsing. Go back to 2022, just a few years ago. Investors were paying 40 basis points more just to get dollars when exchanging currencies. Back then, as rates climbed, the dollar had value. People wanted it. But fast forward to now, and we're entering a completely different world. Soon it won't cost you to get dollars. You might get paid. You heard that right. The market might pay you to take dollars off its hands. That's how undesirable the currency is becoming. Imagine trading euros or yen for US dollars and getting a bonus. It sounds crazy until it doesn't. And why would anyone incentivize holding dollars? Because the value is slipping away. Investors know it. The market knows it. Dollar-denominated assets like treasury bonds are losing appeal fast. And it's no mystery why. Interest payments on US national debt have hit $1.2 trillion. That's just to cover the interest. And with Besson still trying to keep the illusion alive, it's getting ridiculous. His latest move? Pitching the crypto community as the saviors of the US bond market. That's right, he's betting that Bitcoin bros and Ethereum maxis are going to suddenly fall in love with treasury bills. It's absurd. These are the same people who understand dollar debasement better than anyone. Besson's desperate. He's throwing every narrative he can find to keep the bond market alive, and now he's trying to wrap it in crypto glitter. But no one's buying. It's not a strategy, it's a sales pitch. He's turned into this strange hybrid of hype man and financial storyteller, peddling dreams of stability while the house is clearly on fire. But there's one major player that isn't falling for it: China. They've seen this movie before, and this time they're stepping onto the stage. This is their moment. If you want to challenge the US economy, you start by challenging the dollar. That's exactly what they're doing. China is weaponizing their own currency, the renminbi, and they're doing it smartly. The People's Bank of China just fixed the yuan to a 9-month high. Doesn't sound like much? Think again. A stronger yuan is a direct hit to the US dollar. This is not passive, it's aggressive. In chess terms, they've moved the US financial system into check. Not checkmate yet, but the clock is ticking. The yuan fix moved by 20 basis points. That's big. China is making the renminbi stronger on purpose. They're openly pushing its value above the dollars. And that throws a wrench into the standard narrative, because everyone's been trained to think China needs a weak currency to support exports. But that logic is outdated. China doesn't need a weak yuan anymore, not when they're getting dirt cheap oil and commodities from Russia. Their input costs are still far lower than anything the US can touch. So even if the yuan rises 2% or 3%, Chinese goods are still cheaper globally. They can afford to play offense. Meanwhile, the US is stuck. And that's where the damage really shows. Because back in the US, Trump's tariff war backfired. His tariffs didn't protect American industry, they punished it. The average US tariff is now sitting at around 17%. That's a brutal surcharge on imports. And it's not just the everyday consumer who's paying. American manufacturers are getting slammed too. And here's where it spirals. A falling dollar doesn't help when tariffs are this high. It makes everything worse. The cost of importing goods and raw materials goes up. So now, not only are US industries paying more because of tariffs, they're also paying more because the dollar is weaker. That's the double whammy. And China knows it. Take a look at the US tariff rates by trading partner. Countries like Indonesia, India, South Korea, and especially China, who all provide crucial inputs to US manufacturing, are facing tariffs of 15 to 20% or more. Trump didn't just start a trade war, he sabotaged his own supply chain. And now, every time the dollar drops, the costs rise even higher. This isn't a solution. It's a trap. A 15% or 20% crash in the dollar won't fix this. It'll just drive input prices up and choke US manufacturing even more. The problem isn't just the dollar. It's the tariffs. It's the policies. It's the blindness. And at this point, the writing is on the wall. As China pushes to strengthen its currency, the renminbi, it's creating a ripple effect that could become a serious threat to the US financial system. And if you're worried about the state of US assets now, brace yourself. This could be just the beginning. According to Goldman Sachs, a stronger yuan has the potential to lift Chinese equities significantly. The numbers are striking. For every 1% gain in the yuan against the dollar, Chinese stocks could rise by 3%. That's not just a minor bump. That's a major shift in global investment momentum. A stronger Chinese currency means two things: rising corporate profits in China and increasing inflows of foreign capital. Now, if the dollar keeps sliding, and China remains committed to keeping the yuan steady or stronger, it's going to create a powerful gravitational pull. Global investors won't ignore better returns just to stay loyal to Wall Street. At the core of any international investment is the currency you're investing in. And when that currency weakens, your returns can evaporate, even if the underlying asset performs well. Just take this simple example. Even with the S&P 500 up around 9%, foreign investors still saw losses because the dollar dropped nearly 10%. That's a fundamental reason why China is determined to keep the yuan strong. It's a way to attract capital that would otherwise flow into the US, and to gradually reposition China as a central hub for global finance. Now, when the yuan rises against the dollar, it's not just about currency strength. It's also about opportunity. Investors are drawn to Chinese equities for both currency appreciation and stock gains, two tailwinds that amplify returns. And over the past 2 years, the U.S. China trade war has only strengthened China's position. While Washington slaps on tariffs, many countries have doubled down on their reliance on affordable Chinese goods. Beijing isn't sweating a drop in exports because their competitive edge remains intact. But things look different on the American side. The U.S. market is increasingly propped up by debt, massive amounts of it. Margin debt alone has ballooned, surpassing $1 trillion in July, with an eye-watering $14.6 billion added in just a single month. This kind of leverage works great when markets rise. But if the tide turns and capital starts exiting U.S. assets, the entire system becomes dangerously fragile. A sharp reversal could trigger forced selling, collapsing valuations, and turning that mountain of borrowed money into a financial black hole. Meanwhile, China isn't just sitting back and watching. It holds leverage in more ways than one, especially through its near monopoly on rare earth minerals, which are critical to everything from electronics to defense systems. The U.S. depends heavily on Chinese supply here, and Beijing knows it. That's why Trump has been escalating threats, demanding China hand over rare earth magnets or face 200% tariffs. He's even floated the idea of weaponizing U.S. airplane parts in the trade war, arguing that cutting off Boeing components could bring China to its knees. But that logic is flawed. In the short term, China can work around it by buying more from Airbus in Europe. In the long term, China's domestic aerospace company, COMAC, will inevitably catch up. The more pressure Trump applies, the more incentive China has to accelerate innovation and become self-reliant in aviation. That's bad news for Boeing, which could face real competition in a global market it once dominated alongside Airbus. And on the rare earth front, China is already tightening the screws. Though the sector has long been under state control, the government is clamping down even harder, consolidating control over mining and refining, and signaling that it can cut off supply at any moment. This gives Beijing the power to retaliate instantly if tensions escalate. What we're witnessing isn't really a standoff, it's more like an uneven fight. China has options, leverage, and a long-term plan. The US, by contrast, seems to be reacting on impulse. Could Trump have mitigated these risks? Not instantly. But long-term industrial policy could have set the stage for rare earth independence and reduced reliance on China. That opportunity existed. It still does, but it's been delayed by short-sighted decisions. Take Brazil, for example. With the second largest rare earth reserves on the planet, it could have been a game-changer for the US. Washington had the chance to partner with Brazil to develop its rare earth industry. Instead, Trump and his team decided to slap steep tariffs on Brazilian goods, making mining projects financially unviable. These policies don't just hurt Brazil, they hurt America's long-term strategic position. Now China and the BRICS alliance are seizing the initiative, forming new trade frameworks and rerouting supply chains around US pressure. As the layers of this trade conflict unfold, it's clear that the damage isn't just economic, it's strategic. U.S. consumers are paying more, supply chains are breaking down, and industrial independence is being pushed further into the future. So the question remains, will China continue pulling global